Hi everyone, in this video we will talk about counterparty risk and downside risk definitions. Okay, let's go. What's this counterparty risk? Counterparty risk is a likelihood of or probability that one of those involved in a transaction might default on its contractual obligations. Counterparty risk can exist in credit, investment, and trading transactions. Understanding counterparty risk. Varying degrees of counterparty risk exists in all financial transactions. Counterparty risk is also known as default risk. Default risk is the chance that companies or individuals will be unable to make the required payments on their debt obligations. Lender and investors are exposed to default risk in virtually all forms of credit exertions. Counterparty risk is a risk that both parties should consider when evaluating contracts. In retail and commercial financial transactions, credit reports are often used by creditors to determine the counterparty credit risk. Credit scores of borrowers are analyzed and monitored to gauge the level of risk to the creditor. A credit score is a numerical value of an individual's or company creditworthiness, which is based on many variables. A person's credit score ranges from 300 to 800, and the higher the score, the more financially trustworthy a person is considered to be to the creditor. Numerical values of credit scores are listed below: excellent 700 and above, good 700 and above, fair is and like you understood. Many factors impact his credit score, including a client's payment history, the total amount of debt, length of credit history, and credit utilization, which is the percentage of a borrower's total available credit that is currently being utilized. The numerical value of a borrower's credit score reflects the level of counterparty risk to the lender or creditor. A borrower with a credit score of 700 would have low counterparty risk, while a borrower with a credit score of 400 would carry high counterparty risk. If the borrower has a low credit score, the creditor will likely charge a higher interest rate or premium due to the risk of default on the debt. Credit card companies, for example, charge interest rates in excess of 20% for those with low credit score, while simultaneously offer 0% interest for customers that have stellar credit or high credit scores. If the borrower is delinquent on payments by 60 days or more or exceeds the card's credit limit, credit card companies usually tack on a risk premium or a penalty rate, which can bring the interest rate of the card to over 29% annually. What is important, investors must consider the company that is issuing the bond, stock, or insurance policy to assess whether there is default or counterparty risk. Okay, so investments, counterparty risk. Financial investment products such as stocks, options, bonds, and derivatives carry counterparty risk. Bonds are rated by agencies such as Moody's and Standard and Poor's from AA to junk bond status to gauge the level of counterparty risk. Bonds that carry higher counterparty risk pay higher yields, where counterparty risk is minimal. The premiums or interest rates are low, such as with money market funds. For example, a company that offers junk bonds will have a high yield to compensate investors for the added risk that the company could default on its obligations. Conversely, a US Treasury bond has low counterparty risk and therefore rated higher than corporate debt and junk bonds. However, treasuries typically pay a lower yield than corporate debt, since there is a lower risk of default. Okay, now will be the examples of counterparty risk. When the counterparty risk is miscalculated and the party defaults, the impending damage can be severe. For example, the default of so many collateralized debt obligations was a major cause of the real estate collapse in 2008. Subprime risk: mortgages and securitized into CDOs for investment and backed by the underlying assets. One of the major flaws of CDOs before the economic crash was that they contained a subprime and low-quality mortgages, whereby the CDOs were given the same high-grade ratings as corporate debt. The high credit ratings for CDOs allowed them to receive institutional investment since the funds are required to invest only in highly rated debt. When borrowers began defaulting on mortgage payments, the real estate bubble burst, leaving the investors, banks, and reinsurers on the hook for massive losses. The ratings agencies received a lot of blame for the collapse, which eventually led to the financial market meltdown that defined the bear market of 2007-2009. AIC and insurance risk. AIC, or American International Group, offers insurance products for real estate businesses and individuals. The company needed a bailout from the US government during the financial crisis. For those who were insured by AIC by suddenly faced an increase in counterparty risk. As a result, investors must consider the company that's issuing the bond, stock, or insurance policy to assess whether there is counterparty risk. Okay, so what is downside risk? Downside risk is an estimation of securities' potential loss in value if market conditions precipitate a decline in the security price. Depending on the measure used, downside risk explains a worst-case scenario for an investment and indicates how much the investor stands to lose. Downside risk measures are considered one-sided tests within the potential to profit is not considered. Understanding downside risk. Some investments have a finite amount of downside risk while others have infinite risk. The purchase of a stock, for example, has a finite amount of downside risk bounded by zero. The investor can lose their entire investment, but no more. A short position in a stock, however, as accomplished through a short sale, entails unlimited downside risk since the price of the security could continue rising indefinitely. Similarly, being long on an option, either a call or a put, has a downside risk limited to the price of the option's premium, while a short call option position has an unlimited potential downside risk because there is theoretically no limit to how far a stock can climb. Short puts, on the other hand, have downside risk unlimited because the stock or market cannot be below zero. Investors, traders, and analysts use a variety of technical and fundamental metrics to estimate the likelihood that an investment's value will decline, including historical performance and standard deviation calculation in general. Many investments that have a great potential for downside risk also have an increased potential for positive rewards. Investors often compare the potential risk associated with a particular investment to possible rewards. Downside risk is in contrast to upside potential, which is the likelihood that the security value will increase. Okay guys, it's all for today. See you in my next videos. Bye.